Welcome back to another episode of Gimme Some Truth. Today we're talking about alternatives, fortunately not alternative music, which is my favorite, as you know.
Very much so.
But that's okay. It's part of our Market Outlook series, where we're taking the articles that we've written and unpacking them in a podcast, more conversational form, so that people can get a little bit more insight in terms of our thoughts on these and just kind of where we see it going. Andrew and Mitch wrote about alternatives. I know it's a malleable subject, if you will, Andrew, but how do we define alternatives, at least to the layperson?
Yeah, very simply, we defined it in the article as not a public stock or a public bond.
Okay.
Available, through some public markets like exchange trades and indexes and things like that.
It's growing, yes, or becoming more available. That's probably what we should say, right? It's coming downstream in terms of the availability and the ease to be able to utilize these investments.
Yeah, certainly more available to the retail investor, our typical client, right, that we work with every day. Much more available to them. I wrote a lot about the history, and when it began, it was pension funds and more institutional endowments is obviously a very popular one, and we just didn't have access to it, but now we do.
Yeah. Why do we think it's important to our clients? I mean, because you could easily just build a portfolio without it. You could kind of go more traditional, right? Stock, bond, cash. Why is it important?
Well, it gives you an opportunity for a different return profile. And then by sprinkling those different return profiles and overlaying it on top of a public market portfolio, statistics would tell us that you could get a little optimized rate of return in that you can get a little bit more rate of return with a little bit less risk. And it's because some of these have asymmetric returns, or at least non-correlated returns. So when I say that asymmetric, like if you were in a venture capital fund, you could have well above, potentially, like if you did really well in the equity markets and you hit a really good stretch, it might be a 11, 12% rate of return average, But here you're talking about in a venture fund, maybe you're trying to do 15 or 16. Now, you could also go the other way. You could lose, a lot of your investment in these things. But if we sprinkle that into a portfolio over a long period of time, that's where you might be able to obtain that better rate of return. And then if you did something like a private credit fund on top of that, or a real estate fund on top of that, and you put that and has a different return profile, perhaps it's more of an income producer for you, has really stable income, that's where you could maybe reduce the risk, but not really reduce the return that much. So all of these things put together, that's kind of what we're trying to accomplish. Now, whether that happens with your portfolio is really dependent on your security selection.
Yeah.
Are you picking good managers? And, are you making sure that you're picking good formats of these investments?
Yeah, that's a good segue. Andrew, private equity, private debt, right? I mean, help the listener kind of understand just the nuance between the two and where one would work, where the other one might not work.
Yeah. Well, I think you got to preface this as like whether they work or not is all dependent on, you go back to the financial planning that we'll do with all of our clients and have like a risk profile, a liquidity profile, and all of that. And so, private debt, for example, is basically a non-bank channel where you're basically lending money to a private institution. You think of it like a bond, but it's not publicly available, right? You're not using a bank. Same with private equity. And so it's basically, you're working directly and you have contractual agreements that are not, readily available to all investors through their normal stock, ETF, mutual fund channels.
Yeah.
So again, a lot of them are, dependent on, people may come in and be like, hey, like I really want to look into these alternatives. And then you have to kind of go through the conversation of like, okay, what's the goal? Just like everything else, what's the goal? What's the cost? What are the risks? What are the rewards? And how does it affect your financial plan? So it's, again, becoming more prevalent as we discussed, but there's more nuance to them, I think, than, stock bonds.
Yeah, they're getting a lot of buzz now, and I think people are seeing them more in headlines, and you're seeing more Wall Street Journal articles and different kind of more mainstream publications talking about it to the retail investor than maybe they did, decades ago. Clint, let's harken back to say 20 years ago. How did that world look different for the retail investor? I mean, was it even available to them at that point? Or was it you couldn't get there? There were qualifications, things like that.
Yeah, largely no. And the accredited investor and qualified purchaser stipulations, which are kind of SEC rules, they really haven't updated them that much. So a lot of people have just qualified because their assets have started to get larger and larger, and they start to hit these benchmarks and ability to have access to it. And then the Trump administration's made it more friendly, and they're trying to allow more of 401k providers to get access to this too. So there's kind of this deregulation push to try to allow people to get access. Really, pre-IPO is really what they're trying to accomplish, right? They want to get access to this large private investment, particularly on the equity side, this large private investment swath that's much larger than the public market.
So these are companies that are, in some cases, everyday names that we've heard of, that we deal with, that we use in a business sense or in a personal sense, but may not be traded. They haven't gone IPO. They haven't gone initial public offering, which means that they're not traded on an exchange, but they're still in many cases, a highly functioning company. It's not your, the mom and pop laundromat down the street. It's big names that just haven't gotten to the point yet where they've gotten a ticker symbol and gone public.
That's exactly right. Now, the downside of that is, how do you exit, right?
Sure.
So, if you have these providers, some of these have been going on. If you take some of these payment processor places, you take this like Stripe. Stripe's been a private company for a really, really long time, plus 10 years. And so if you got in at any point, what's your access to being able to get out? So you've got to find a ready buyer. It's not just, you just push a button and sell. So it's not a simple situation. And then when you buy them, how are you going to buy them? You have contractual agreements directly with shareholders. You have special purpose vehicles. You've got mutual funds that can hold them. So it's a very nuanced and complex situation. And on top of that, it can be very expensive to purchase into these things. There's all sorts of layers of fees. So it's really, I'm glad that they have some levels in many cases of saying, hey, you got to be these certain investor types to be able to allow yourself the ability to not be able to get your money back for a long time. So that liquidity in there is really key. And in many cases, you don't have a lot of liquidity. And the liquidity can be gate kept in the most painful of situations. So they can just basically board the door up and be like, you can't get your money out if we have a big run on this. And so that's where it can become difficult. And that's where we have to have plenty of other investments that are liquid outside of this.
Yeah. Andrew, speak to that a little bit, the planning and the importance of that before somebody would even, get close to making an investment in it. What are the boxes that we're looking to check before they get to that point?
Well, a couple of things that we mentioned before, like their risk tolerance, the risk reward of any of these investments, liquidity that Clint just talked about. If people are in distribution mode, and they're requiring income from their investments, like a lot of these things may not be on the table because of the inability to get it out. So those are two really big ones. One of the things I think Mitch did a really good job of describing is like kind of an in-between. It's called an interval fund, where you don't have to go all the way into the hedge fund or a private credit, a contractual agreement. It acts more like a mutual fund. Where it has some liquidity restrictions, but not like full stop, no way you can get it out now. So there is an in-between to kind of put your toe in if someone is really, bent on getting that in their portfolio.
Yeah. I think we generally think maybe 5 to 10% of a portfolio if you want to really try to take a garden variety situation. But we're really talking about investors that have at least $1 million of investable assets, if not more. Is that fair to say?
Yeah, I would like to see it in that. I mean, some people try to sprinkle it in earlier than that. Interval fund structures oftentimes do not have any requirements. I do like interval funds a lot, but you do have to be careful about how much you put into those. If we're talking about, okay, I got a big IRA balance, I'm not touching it for a while. Okay, and you're below $1 million, maybe. But overall, there's sophisticated investments with return profiles that can be all over the board. They do require a lot of due diligence. When we meet as an investment committee, we basically have to okay those, the use of those. We can't just, go out and buy whatever we want. So we're doing a lot of due diligence behind the scenes. And because they're so different and they have different fee structures, you really have to look at what's underneath. It's not just as simple as pushing a button and buying a stock. So, tread lightly and carefully.
Yeah, and I think it's exciting in a way because we see it as almost the kind of iteration of another kind of slice within your portfolio. It's not just stocks, bonds, cash. We can also have an alternative slice, which just behaves different, acts different, looks different, and that can be a good ballast in somebody's portfolio if the market gets more volatile.
Yeah, absolutely. I think it's the non-correlation that Clinton talked about earlier is a big incentive for getting in this or having this slice of your portfolio, especially when we're talking like times right now where we've been on a pretty massive bull run and there's unease in the market and all sorts of other market conditions going on with politics and geopolitical things like that. It could be a slice that reacts differently than your stock bond. So
Yep.
it's interesting in that way, but there's also there's still that risk and fee sensitivity. I think is something that, like, I don't know if our clients understand how expensive some of these are, and so that's another piece that's really important to that we obviously disclose to them, but have a full understanding of, like, maybe 3% or something like that is normal in an alternate.
Yeah, and it doesn't make it bad, right? Inherently,
Correct.
right? It
Correct.
just is, we need to make sure that we're getting value for what we're paying for, and I think that's part of the analytics that we do before we put it in front of a client.
Exactly. Yeah.
Clint, as we wrap up, where do you see this world, this alternative investment world going in the next year, 3 years, 5 years? I mean, does it just continue on the path that it's on, become more available, does it get wider as far as choice, that kind of thing?
I do believe we're going to have more choice.
And potentially into 401ks and things like that.
Yes, we're going to have a lot more choice, I think. And so, you're going to have to be really careful about how you look at these things. But also, I do believe that we're going to see tokenization of a lot of private securities, and that will be a game changer. So we're going to actually be able to purchase, tokens that basically run with these private companies. And so, not to get too deep into it, but it might be an ability to unlock those on an easier way where the rates of return will parallel these private companies. So you might not own the share, but you're going to own a token that kind of replicates that share. And if we end up doing that, the accessibility will explode with private equity, perhaps. And they might even tokenize debt like that too. Wouldn't surprise me. So, that is kind of the typical stuff. And then beyond that, we have all sorts of different option strategies and other things that do fit in the alternatives bucket. So it's so much more vast than we even give it credit. And what I think investors should do is keep an open mind. It is highly unlikely that we see the S&P 500 replicate what it did the last 10 years. One of the finest 10-year periods that we've seen, really. So if we want to make sure we diversify well, I think you should consider these. And I think index investing is important because it's cheap. This investing is like the opposite of that. It's super expensive. But I think there's value in a lot of pockets there, and it should be part of a lot of portfolios. And so that's why, and fortunately or unfortunately for people, to get these sorts of investments, you really should use a financial advisor. You need somebody to dig into these things and really understand them, because the regular investor probably doesn't have the depth of knowledge that you need to be able to properly go out and look at these things and determine whether or not they are an actual fit in your portfolio relative to all the other choices out there.
Yeah, I think that's a great cautionary tale, because it kind of falls within the construct of, just because you can do something doesn't mean you necessarily should do something. Just because these things are becoming available doesn't mean we should just jump out and put those in our portfolios. And it's a world that also is kind of just getting figured out, if you will, by way of the retail investor. And so that also kind of lends to some potential pitfalls that you might not be aware of. So if you want more information about this topic, definitely read Mitch and Andrew's post within the Market Outlook. It was very, very well done. If you want to know how it specifically relates to you and your portfolio, definitely talk to us, book an appointment, come in, and we can talk you through the options that we see are good fits for our clients. So thanks so much for another episode of Gimme Some Truth, and we'll talk to you soon.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.